Hey, and welcome back. In this video, a few examples of companies that are in a declining trend, and that can be very interesting. Companies with a sustainable competitive advantage can be very interesting for long-term investors. However, the problem is often that the valuation is on the high side. This is because companies with a competitive advantage, they can defend their competitive position and possibly expand in the future, thereby making more profit. This means they are very interesting investments for the long term. However, often the stock price is also fairly valued or frequently overvalued. However, when they are in a declining trend, it can be interesting as the patient investor takes advantage of Mr. Market, whether due to short-term issues or factors manifesting, causes the price to decline. This makes the stock price more attractive, allowing us to buy below intrinsic value. Consequently, we can achieve relatively high returns. More importantly, we can sleep peacefully because we are investing in high-quality companies and do not have to worry about daily or weekly concerns. It doesn't matter anyway. My name is Yorick Vermeulen, and I am happy to help you invest simply and with confidence. I have been doing this myself for over 10 years, have become financially free, and perhaps even more by now. I would also love to help you. Visit our website and download our free books. Stock book, ETF book, we should actually reverse that. ETF book, stock book, but also various investment tools. And it's been a while since my last video, as I was moving. You can see it, new background. I really enjoy being outside. I love being in nature. So I will try to be outside as often as possible. Enjoy the view as well. That's what it's all about. You have money, you let it work for you, and ultimately, you try to enjoy life with it, whatever that means for you. More freedom, being able to be more in nature. Buying a car, if that's your thing, I wouldn't advise, but anyone can make their money work, let it compound more and more by actually doing nothing, just by investing and being patient. And then you can use that money as a means to do things that add value to your life. That is also what happy investors and business investors stand for. We are focused on achieving financial freedom, investing, and viewing money as merely a means. It is not important at all, but sometimes it can also be a fun hobby, and at times it can be frustrating when prices are falling. Moat companies, or companies with a competitive advantage, provide us with both peace of mind and the potential for high returns. In this edition, a number of interesting examples. ASML is a favorite investment, and ASML is also a company with a strong sustainable advantage. But the question is ASML a good investment today for the coming years? First of all, ASML is a long-term position, and I have personally held a long-term position in it, and I will show it to you below. The first time I purchased ASML was in 2018. A few times since then, I sold it once. I bought additional shares several times and then sold positions in ASML, particularly in 2021. When we look at the chart, it seems like almost perfect market timing for buying and selling. But be aware, I am not a market timer. I simply invest long-term in companies that I believe are quality companies that I buy at a good valuation. The problem with ASML is often that it is overvalued in my opinion, and that is why I sold it. We see sales here in August 2021, in October 2021, and then in November 2021. We see here on the screen that in August 2021, I sold a portion, which is almost at a peak compared to the decline towards 2023. And we also see here that in November, I sold almost at the peak, but that was just luck, not market timing. But here, the valuation of ASML was very high. Then I bought ASML once again in 2022. October, so that is about here. So you see, I bought back in significantly lower than the moment I sold. And then I held on for a long time, but I sold a larger portion and actually my entire position in ASML in June 2023, part of it. That was just taking profits. And then I sold my entire position in April 2024 and in June 2024. And when we look at the training view, we see April 2024 and June 2024. That was again almost at the peak. So I am not a trader at all, but the market timing is almost perfect with ASML. How is that possible? Luck. But mainly just looking at financial valuation. If the financial valuation is very high, even for a great company like ASML, then the upside potential is simply lower than the downside potential. And you simply sell when valuations rise too high, and that is not as difficult as people want to make it seem. You just need to look closely at the financial valuation. And simple ratios are also there to help you, such as the price to earnings ratio and price to cash flow ratio. And if they are all very high, then you need to carefully consider what the risk is that the stock will decline in the short term. I also want to add that ASML is a great stock for the long term, at least that's what I think, but even ASML's unique position in the semiconductor industry with their high quality machines is susceptible to disruptive innovation. And I am not an expert in that, and you probably aren't either, which is fine, but if you are not, then you need to be very careful about the price at which you buy your ASML. Now, for a whole day, we see another decline in the ASML stock, and the current price to earnings ratio is around 35. The question is that still a good price? Well, I can tell you that I only feel motivated to buy ASML again when the price to earnings ratio is lower than at least 35. Actually, it should become interesting again below 25, but of course there are several ratios that are important to determine. And don't forget, ASML is a cyclical stock, so you can use cyclical movements to your advantage. What is happening now is that the valuation is high, and suddenly it may face challenges for a few quarters. And the market, Mr. Market, reacts sharply. This is often the reaction with overvalued stocks. When future expectations are not realized, at least in the short term, the market reaction is severe, leading to significant volatility that you, as a long-term investor, can benefit from. However, I would not enter the market just yet, and I will show you why. First of all, the fair value estimate from Morningstar. As you are used to, we always show that, and they estimate ASML at a price of 900 euros, and that is significantly higher than the current price. So even after this price drop, the number seems to have become more interesting. They also indicate that the economic mode is wide. In other words, a strong competitive advantage. I agree with all of that, and the price target from the analysts is also significantly higher than the current price, but still, I tell you that the price to earnings ratio is still relatively high. How do we see that? For example, when we open fast graphs, it's just a bit simpler because we are now using data, numbers, and statistics, which saves you some thinking. Only when you want to make an investment will you create the scenarios you need to make, and you will want to calculate the intrinsic value yourself. If the PI ratio is above 30, it must be a great stock. The PI is around 34. Recently, the PI was 50. I sold my position, and now the PI is dropping. Let's take a look at the forecasting calculator. It takes into account that the industrial value from Morningstar of 900 euros is calculated based on an infinite lifespan of ASML, indicating significant long-term growth. And what we see here in fast graphs looks at up to 2026, and that is therefore more short-term. But for the sake of convenience, let's assume that the current PI ratio of 34 remains the same in 2 years. If ASML can achieve a growth of what is expected below, 23% and another 23% in profit growth or earnings per share growth, then ASML could achieve a return of about 20% from this level. So that sounds quite plausible high. However, a PE ratio of 34 is particularly high. So let's say, and we are a bit more cautious, and we assume 25, then the potential return is only 5%. However, there is also a scenario where things could go quite poorly, and the PI ratio, for example, is temporarily 20%. In that case, you would see a downward potential for ASML. Of course, if you look at long-term growth, you will see a different situation. The long-term estimate of EPS growth until 2029 is 16%. Now, I can't adjust it myself, so that's why I say you need to manually make a calculation if you want to calculate the intrinsic value. But this is purely for illustration. If this is true, that 16% EPS growth over a much longer term, then one must take into account that ASML is becoming larger and larger. Most of the time, as you grow larger, it becomes more difficult to achieve consistent profit growth. So profit growth should quickly reduce to a normal level, even an industry normal level. Although ASML is certainly a top company, if this is the case with long-term growth, then the total annual return is about 5 to 6% relative to the PI ratio, as shown here. So depending on which perspective and scenario you look at it from, ASML may be interesting, but I think ASML could become much more interesting if the stock simply declines further in the short term. And you must always keep in mind that you can only invest your money once at this moment. So is ASML the best option? I think it's a great company. As you can see, I have invested in it myself for several months, but I believe that there are simply better options than ASML at this moment, purely based on the valuation. The valuation is simply on the high side. We also see that the PI ratio at the moment is 36. For next year, it is estimated to be 35, but this is of course a less favorable year, as ASML has also announced. More importantly, however, is that the failure ratio, which is calculated over 5 years, is still 1.7. Well, for a good stock, an acceptable ratio might be 1.5, but we prefer stocks with a failure ratio below 1, ideally well below 1, which means the downside potential is actually relatively lower. You also see that the price to cash flow for next year is estimated at 35. The sector median is significantly lower, but you should also compare ASML with companies like Nvidia, Apple, or Netflix. I'm just mentioning a few companies. And then you always have to ask whether ASML is a better choice compared to those other superior companies. And then what's even more interesting is, okay, but maybe those superior companies are all very highly valued. And maybe there are some really interesting value, dividend, or growth stocks that you can buy for a much better risk profile with higher upside potential in terms of returns. For example, at this moment, my stock app. Loving has a return of about 230% in 1 year. Those are nice examples. You see, not all are equally successful, but it is, of course, about a few outliers with potentially high returns. And Aploving is currently growing much faster than ASML. However, Aploving also has a high price tag at the moment, so it is certainly not without risk. Looking back at ASML revenue growth, look, for the 5-year average, these are of course just excellent figures. But you see, if the valuation is high and things are not going well, and don't forget ASML is in the cyclical industry, then the stock price can simply decline more in the short term. We see that the EPS growth is estimated to be 20% next year. Well, that aligns with what we just saw in Fast Grabs. And the EPS growth for the longer term, 3 to 5 years, is estimated at 20%. Those are indeed really striking figures. However, keep in mind that the EPS growth has already been factored into the bad luck ratio. The bad luck ratio is 1.77 at the moment, and that is all according to the estimates. And that is not super interesting. It would be more interesting to patiently wait until ASML drops further. There is no rush. If you are just lucky, you can buy ASML at a very good price. And if you're not lucky, well, at least you haven't lost any money, because you can only lose money if you put money at stake. And of course, you can only realize returns if you put money at stake. But you have to ask yourself whether ASML is the best choice, even if it's just in comparison to an ETF, for example. Well, of course, the profitability is interesting. You can also see that ASML scores superiorly in terms of profitability. Net income of 26% in line with the 5-year average. By the way, not yet mentioned, but the CEO and another high-ranking official of ASML both have left, and that is really not favorable for this company. However, they also indicated in their podcast that we have positioned the company in such a way that success can be continued. That is also what Warren Buffett and Charlie Munger indicate, as they prefer to invest in a company with such a superior earning model that even a monkey could manage it. That is, of course, what you want. The return on equity is currently very high. The 5-year average is also higher, which again shows how superior ASML is even within the semiconductor industry. We turn on total capital above 20%, so ASML is rightly a popular favorite stock. But in the very short term, Schenck indicates that it is a hold. And if you look at the technical analysis, you don't need to be an expert, but you can see that there is a downward trend occurring. 2 sell indicators based on our long-term trends, and we also see in the short-term trends that the MACD is starting to turn negative and below 0. And the stochastics is not particularly encouraging. But more important in this case, I think, is the MACD line in combination with the long-term price trend. A further decline could indeed be potentially realistic at this moment. It would be very nice if the price drops in the short term to around 550, 560, but that is purely viewed from a potential support level, from technical analysis. Much more important is, of course, what is your intrinsic value? What is your fair value estimate? Morningstar's is 900 euros. That might be a bit on the high side, but of course, this is about thinking long term. And if you think long term, it's simpler, because then you can buy a very strong company like ASML at a Yes, maybe even a somewhat higher price than what you would want to pay in the short term. Only if you simply wait for a very long term can you still achieve an attractive return. In summary, I would not buy ASML at this moment because I believe there are better opportunities and better companies than ASML, and I would simply wait. If the price to earnings ratio, for whatever reason, falls below 20 in the short term, then I think ASML would be very interesting. And if not, we just continue with life. The sun is shining, the weather is nice, but we also worry about it.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
The share of Evolution is declining, and this may be a significant opportunity for long-term investors. Evolution is a company. It is an online casino company, but it is a kind of online platform that offers online services in casinos for various other casino operators. Especially in white label and business to business, it's a super interesting company. I once shared a lot of in-depth information. The CEO has been a member since 2015. The company thinks from the perspective of shareholders, considers return on equity, and thinks about share buybacks, which they have also done in the past few months, although it only represents about 2% of the total outstanding shares. They are considering whether or not to pay dividends, although that is actually my reason for not wanting to invest too much in Evolution. And actually, the only downside I see to this company, which is currently declining, is that they are specifically focused on a sector, namely online, casino and gambling, which can be quite risky in terms of political interventions. If the government decides to tighten regulations, it is detrimental to Evolution, but this company is active. Fascinating. It is a mini acquirer. They buy smaller casino operators, especially online offerings. They also develop casino games. I think that Evolution is a very interesting company, but much more importantly, the stock is also interesting. The valuation is simply good and really seems like a no-brainer, but as often happens, I might be wrong. Anyway. As I show you, Evolution is currently my largest position. I do not want to exceed 10% in this account that I have, so my position is currently 20,000 SEK in Evolution. And I may have bought a bit too early, but I'm not worried about that. It is currently down 10%. However, I believe that Evolution is undervalued with really high upside potential, but we will see. Time will tell. Evolution has gone into a negative trend at 1,300. I will show you this in my analysis. But first, of course, from my perspective as a long-term investor. Let's think about the intersecurity values. The situation with intersecurity values is difficult. The estimate from Morningstar is the best. SEC. Now SEC stands for Swedish krona. You can also look it up in euros or dollars. It seems a bit confusing because when you search for Evolution, the stock shows something like 200 billion SEK. The company alone is valued at around $18 billion in euros or dollars. An 18 billion SEK company is not super large. It is large, but we have often seen companies valued at 20 billion easily grow tenfold to reach 200 billion. And I believe Evolution is such a company. Of course, we are talking about the long term here. In the short term, the price target from analysts is approximately plus 44%. The upward potential seems to be at least plus 30%. The historical valuation of Evolution indeed suggests that the stock appears to be significantly undervalued. Never before has the PI ratio been as low as it is today. Currently, the PI ratio is 16, while the future growth still seems plausibly high, despite all the necessary risks associated with this earning model. We also see this reflected in the forecasting tools based solely on the short term. By short-term forecasting, I mean the next 2 years. The normal multiple of Evolution is a PE ratio of 30, and that seems a bit on the high side to me. Based on that, the total potential annual return is 160%, with an average annual return of around 50%. But let's assume that Evolution continues to trade around this price level of 18, and they can achieve a profit growth of exactly 18% and 14% EPS growth. 18% and 14% PS growth. Then the annual average return is 25%. Also, if you look at the long term, which is of course much harder to estimate, but when we assume a PE ratio of 15 and also an EPS growth of around 15%, which I think is realistic. For this type of company, it is not excessively high, and it could also achieve an annual average return of 18% in the long term. And now let's take a look at alternatives such as the Magnificent 7 or the S&P 500. All high valuations, a PE ratio of above 20, even 25 or higher. And here we have a gem, Evolution, listed in Sweden with a PE ratio of around 16. A sublime earning model, which we will also see shortly in the profitability and profit figures. And also, looking at, for example, the margins, it is higher than the sub-industry average, or the comparable peers. Do not confuse and compare Evolution with other casino companies. I once read an analysis by an analyst who compared Evolution with casinos. Fucking bullshit. Evolution provides high margin products to casinos. They make money from all casinos worldwide. Evolution has a scalable business model, much more superior, with much more diversification and risk spreading. The only thing is that Evolution stands out with the growth of online gambling worldwide. And that, of course, also has regulation and governments that can intervene, which can have a detrimental effect on Evolution. But if we look at, for example, the operating margin, which is very interesting, it still scores a higher margin of 16 to 15% compared to the sub-industry, recently 12%. So currently the operating margin, or the EBITDA margin, is around 60%. Let's delve further into that profitability margin. You can see the EBIT margin around 62%. The EBITDA margin is around 65%. Net income is around 65%. And the 5-year average is also above 50%. So it is a very lucrative and profitable earning model. Yes, over time, it can all decline, and it likely will as the company gets bigger and bigger. But it is still interesting that they make so much money. And more interesting is the return on equity, which averages above 30% over 5 years. It also remains around 30%, and the return on total capital is significantly above 15%, which I believe is a strong indicator of a company with a sustainable competitive advantage. And that is also one of the reasons why I do this and why I mean this. Development seems very promising, but we can of course miss the mark. That is the uncertainty of investing. In the market, the share is not valued as highly, so there are trading opportunities. Many analyses don't align. Possible solidarity may also make assessments that show an attractive profit opportunity. The current PI ratio is, as mentioned, at 16, and the luck ratio is around 1. That is quite nice for this type of company, if you ask me. However, a downside is that the price to sales ratio is, for example, high. They generate around 2 billion SEK in revenue, and the current market value is around 18 billion. So the price to sales ratio seems very high, but the valuation is justified in my opinion given the higher profit margins, and there isn't really a reason to assume that those profit margins will suddenly drop drastically. The dividend yield is currently 3%. Actually, I find the downside of Evolution to be that they are paying out the dividend. I would prefer to see them buy back more of their own shares as they are currently doing. They are now buying back shares up to 2%, and according to their policy, they are allowed to buy back a maximum of 10% of their shares. I would think, why don't we just buy back more shares? That would at least be more appreciated by the shareholders in the short term. And management can then show as a sign that, hey, look, our company is indeed actually undervalued. We are now buying back shares, and we can later issue them at a higher price, allowing us to raise more money and achieve a return on our own share buyback program. Now, the revenue growth is naturally slowing down, which makes sense. Therefore, in the short term, that declining trend is also ongoing. The 5-year average showed that revenue growth was very high, and for now it is estimated that revenue growth will be above 15%. And also the EPS growth, as indicated, is estimated at around 15%. Even for the long term, that is still 15%. Other growth figures are still simply outstanding. So we are just seeing a short-term stabilization, if you ask me, of the share of Evolution. What may have been valued a bit on the high side at first, but since that peak it has dropped to about minus 37%. The fair value is estimated at around 1300, and that 1300 is roughly around this level. This means that you can cause the upward potential of the economy in a certain way. It seems both in the short term and possibly in the long term, at least in the short term as possibly in the long term. The exact reason why the share is dropping so much in the short term, I'm not sure. If you believe in technical analysis, There is a possible lower support level around 800. That means there could be quite a significant further decline. The only thing I know is that I have allocated 10% of my money to this stock. That is quite a lot in terms of allocation. That is actually the only company Evolution that currently has such a high. That is the only thing I know. I think it is undervalued. I believe it is a great company for the long term, and that I can achieve attractive returns here. But why is it declining in the short term? We will see who has the advantage, the long-term or the short-term investor. Note that we never give personal advice. I also never give stock tips. I only indicate what I do, what I think is useful for my money. Sometimes I'm right, and sometimes I'm not. It can always be disappointing, so be careful with what you do. Never blindly copy someone. Research this company yourself. Find out why I might find this interesting company. But also consider for yourself, what are the risks? Is there also a risk of losing money in the long term? That is the real risk you need to realize when investing. I am curious about what you think of Evolution. Let me know.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools, where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
Another stock with a strong moat or competitive advantage is the Hershey Company. The Hershey Company is clearly in a negative trend. It has declined by 31% since the all-time high, making the valuation much more attractive again. Let's first simply take a look at the fair value estimate from Morningstar. The Hershey Company receives a Morningstar rating of 4 stars, and the fair value according to this company is $210. The current price is $180, so it may be that the Hershey Company is slightly undervalued in the short term. However, although I am familiar with the company itself, I have never really delved deeply into it. I do know it has an economic moat, but I do not own any shares in it myself, so you are always less powerful in your analysis. Therefore, I will present some data and graphs for inspiration so that you can form your own decision making regarding the Hershey Company. Of course, you also need to look at the annual report and, even more importantly, consider the future and think of scenarios. The average price target from analysts is around 200, so they also indicate that it could potentially be a buy in the short term, and the consensus is still a hold. This could certainly be in relation to other potential stocks. Looking at the historical valuation, we see that the Hershey Company has actually been well above the fair value ratio of PE 15 for quite some time. The Hershey Company has been following a PE ratio around PE 20 for a reasonable period, which is represented by the blue line, what they call the normal multiple for this company. Actually, you need to zoom in a bit to, for example, 7 years, and then we see that for a long time the price has been below the standard multiples. So from that perspective, it may be interesting, but it is still above the traditional PE of 15. Let's look at the forecasting tool. Well, nobody can forecast. We know that, Nassim Taleb. The black swan events, but also just randomness and fullness, all those kinds of things. It is just difficult to predict the future, but what we can do is at least perhaps look ahead to next year. In this case, 22 analysts and 13 analysts have made an attempt, and they come up with a consensus estimate, or a weighted average of analysts. With an EPS of around 9 and 9.8, this results in a slight contraction compared to this year. And for 2026, a small growth of 8%. That's not very much, even though it is a strong company. Revenue seems to be relatively lower in the short term. The normal multiple is around 24 based on the 2 5-year averages. Maybe we should actually base it on 10-year-olds, but then you have 24, so that's still the same. Despite this contraction in 2025 and a slight increase in 2026, the stock could still deliver returns according to the normal multiple and relatively high, averaging 15% per year. However, if we look at what the normal PE ratio should be for this type of company with this short-term growth expectation, you would have a PE ratio of 12 and would realize a loss of an additional minus 30% in total. I think that is on the low side. For example, if you take 16, you would hardly make any profit or loss. Actually, you should start thinking about the valuation of the Hershey Company here, and I can assure you that there are much better stocks available at this moment. It is quite clear that the opportunities weigh in your favor, and with the Hershey company, it is clearly the case or not. In other words, questionable, so you need to analyze more. There may be opportunities there as well, but why go through so much effort when there are simply easier and better companies available that have potentially higher upside potential? Also, check our website for value, dividend, and weekly growth stock analyses, including the monthly update on stocks that have the potential to achieve much higher returns, in this case, Hershey. It is interesting to note that the return on equity is particularly high, and that is also one of the reasons why we do this, The equity is bizarre, and thus always leads to outperformance compared to the industry. And when we look at margins, we see a somewhat similar story. It also reaches higher, a higher cross margin in this case, with a difference of 16% compared to the industry. Looking at the operating margin or EBITDA margin is around 30% compared to about 14% for the industry. So, quite interesting. The Hershey company has very strong profitability, but the valuation is currently not very attractive compared to the potential growth. But do we see that reflected? We see it reflected in the luck ratio, which is 5. The luck ratio takes into account the EPS growth over the next 5 years compared to the current PI, and I must say, 5 is quite low. In this case, the higher the worse, so a bad luck ratio of 0 would actually be very good, but that almost doesn't exist. But for example, 0.5 is seen more often, which means that the Earth is potentially very undervalued. That is, of course, what you need to do if you want to invest in this. They should hold, for example, crypto cash over the next year is 14, and that is just neutral. It seems that the company is currently operating around intrinsic value without actually conducting in-depth analyses, and that is, of course, what you need to do if you want to invest in this. But it could potentially be an interesting dividend stock. The dividend is around 2.8%, and there is also dividend growth. Well, in any case, for next year they expect a dividend growth of 13%. However, in terms of revenue growth and EBITDA growth, it seems less interesting in the short term. The question is, of course, can the Hershey company grow exceptionally high in the long term? Looking at the market value, 37 billion in market value is not an extremely large company. Well, large means that revenue and profit growth will naturally be somewhat lower in the long term, especially for this type of earning model. However, they do achieve higher profitability, which can be interesting for dividend investors. The debt is manageable in this case, and a bit of cash seems to indicate that, at least in terms of solvency, things are okay in the short term. Look at the profitability grade, which is excellent for the Hershey company, and this shows that it is a superior company. In other words, a company with a demonstrable sustainable competitive advantage. This is especially evident when looking at the 5-year averages. The gross margin, as we indicated earlier, is well above the sector median. In this case, 35%, resulting in an outperformance of nearly 10%. The net income margin has also averaged around 16% for the past 5 years. The return on equity is very high, as is the return on total capital, so this company scores very high on profitability. However, there may be a better opportunity arising in the short term. Zegshenk gives a sell. Why? Good question. The price target from Hershey is $200, so that aligns with other analysts who also have a target around $200. Morningstar's fair value S&M is around 210. So it actually seems that the upside potential is not very high. The question is what the revenue will do in 2025, as the market is, of course, looking ahead. And in the case of Hershey Company, it is a very well-known company. Many analysts have made an assessment, so usually market efficiency plays a role here. You often find undervalued companies when the market is inefficient, which is usually the case with smaller companies or those that are disliked. But the Hershey Company seems to be fairly valued, meaning you can achieve a decent return, but may not outperform the market. Additionally, since the PE ratio of the Hershey Company is slightly lower than that of the S&P 500 at the moment, it raises the question of whether it is truly the best choice. As I already mentioned, since the Altium high, the value has decreased by 33%. Technical analysts will look at a support level. We can set it on candles. Then we see here a negative candle line. But more importantly is the MACD. The MAC. It is therefore a question of whether at the current support level around 180, it finds support here and moves upward, creating a downward or horizontal movement. or if the stock will continue to rise. This is purely technical analysis. I don't do much with it when it comes to long-term investing. However, you should include this game in your overall decision-making, not as a decisive overriding factor, but more as a tool. The most important thing is to invest in companies that are undervalued and also have a competitive advantage. Well, Hershey seems slightly undervalued. The undervaluation may be greater if revenue growth and profit growth are higher than expected. But that is the question. Only you can determine that after a lot of research, and that is why this analysis is the inspiration. I am curious about what you think of the Hershey company. Let me know.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools, where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
Etsy shares have been declining for some time. They have fallen by 80% since 2021 and by 60% since 2023. According to Morningstar, Etsy has a wide moat, meaning a sustainable competitive advantage. This video is part of a larger video about fashion stocks that are currently in a negative trend. It is not the most interesting, but still quite interesting. It receives 4 stars from the Morningstar rating. They have also indicated that according to their analysis, the fair value asset is still around $100, while the current price is close to $50. Analysts are somewhat less positive in the short term and give a price target of around 64. If you have been investing in Etsy for the long term, this stock has probably caused you a lot of frustration because it is indeed quite a good company. It has a competitive advantage with their entire community of handmade products that people create themselves and, of course, promote themselves. Etsy has launched a number of interesting features, such as the gift mode and also the ability to advertise on behalf of your webshop. But there are, of course, large competitors, and I personally have no position in Etsy, but I do have a position in Shopify. And I find Shopify to be a much stronger company than Etsy. But it is, however you look at it, a niche player with potential for upward growth. The only problem is the valuation. That has been the case for a long time. For a long time, Etsy was valued with a PE ratio of over 50. Nowadays, the PE ratio has even fallen to 22. Nevertheless, if we look rationally at the facts based on the forecasting tool, we see that the EPS expectations are not shockingly high. This is also based on what management has indicated. So, an EPS growth or earnings per share growth of 12% and 17% in 2026 is not enough to justify a PE ratio of around 30. However, it may justify a PE ratio of around 20, because a PE ratio of around 15 would be very low for Etsy. But the stock is still in a negative trend. Now suppose that Etsy is indeed worth a PE ratio of 15, even with the current growth. Because the price is on the high side, it would yield a possible return of minus 5% per year and minus 10% in total. Assuming a PE ratio of around 19.5, Etsy could provide a slight return from this level, but this is not at all interesting compared to all the other potentially interesting stocks, such as Evolution, which I have highlighted in the news alongside other stocks, and which I believe is much more interesting than Etsy. But however it was turned around, Etsy does have interesting features. For example, the luck ratio is around 1.26. The only thing is that management needs to do something, or there needs to be a macroeconomic stimulus that encourages people to spend much more at Etsy. At this moment, the revenue growth is simply not good enough. As a result, the valuation is also not very attractive, although the price to cash flow of 10 for next year is not on the very high side. But it is also equal to the sector median in value when compared to others. And that is a very important point. It is also an important point, although the market share of 6 billion is on the smaller side, it is interesting for the growth potential that comes with it. That they also have 2.4 billion in debt. So the enterprise value is 7.3 billion. While they do have 1 billion in cash position, the debts are also somewhat on the higher side. However, this is not really a problem compared to the EBITDA, so the debt to EBITDA ratio is below 3. That's just fine. However, I think there are many better stocks than Etsy, especially when it comes to growth. For some reason, the stock just cannot resume the growth it achieved in the past period. The 5-year on-average growth rate from Etsy is indeed impressive. For example, looking at the EBITDA growth. The 5-year average was around 50%, and for the following years, it was even 20%. Today, we actually see that the EPS expectations are around 3 to 5 years regarding CAGR. About 10% is so not very interesting overall when you compare this to other stronger companies with a better, stronger competitive advantage or a stronger mode. Now, that net income margin is also not extremely higher than the sector median. Although this is a 6% outperformance, you must understand that there are also quite a few other types of companies in that sector median. Etsy is primarily classified in the consumer discretionary sector. Well, there are also many non-scalable online earning models involved, so that 10% net income margin is not very interesting at all. All in all, we are not super enthusiastic about Etsy. It is a nice website. It does have real economies of scale. It operates in the niche. It is the niche market leader. This has allowed it to grow. However, as investors, we see better opportunities in other companies. Visit our site for that. Weekly value, dividend, and growth analyses. And I think that they all offer much better opportunities than Etsy at the moment. However, the stock is starting to become attractively valued, and it may possibly grow in the long term simply because of their position in the market and that strong backing. ZexRank indicates it is a hold for us, and their price target is set at $60. This corresponds with the other sources we just saw. They provide various benefits. Reasons to buy, but also reasons to sell. Perhaps it doesn't matter. Interestingly, the current price line is well below the EPS trend line, which is always favorable to see, but we have already seen with fast grabs that the growth potential is rather modest. Unless something happens that causes Etsy, for example, to launch something radically new and resume rapid growth, the PE ratio will naturally rise in anticipation of further growth. As long as that doesn't happen, it remains a very long, slow, boring, and painful journey for investors in Etsy. Since 2023, the stock has decreased by 64%. It can get even worse. Since the peak mania in 2021, the all-time high for Etsy has dropped by 82%. The price level is now even around that of 2018. It will take a long time. I think Etsy is starting to become interesting for long-term investors now. It is possible that in the short term the stock may decline a little further, making the valuation even more attractive. We have seen that the luck ratio is around 1.5, not super attractive, but also not extremely high for a company with a moat like Etsy. So yes, it is starting to get interesting. However, I personally see much better opportunities in other stocks. Also, follow our stock analysis and my own portfolio updates, which I believe have a better chance than Etsy. Thank you for watching, and definitely let me know what you think of this. Kering is a company known primarily for its fashion brand Gucci, which accounts for approximately 70% of the total revenue. In 2023, a CEO was appointed. It hasn't performed very well, as since that moment, around July 2023, the stock price has further declined by 55%. But if you zoom out, it was actually a kind of wall ship. Since 2021, when the valuation was very high, the stock has dropped by nearly 70%. A new CEO has been appointed. This could potentially give the transition new momentum. But Kering still needs some time to grow. Nevertheless, this can be a very interesting company. It has a small competitive advantage with a number of strong fashion brands, including something with Bodega and Gucci. And we will see. It may be an interesting stock tip for long-term investors. I personally do not own shares in Kering and am not very familiar with it. I would rather go for Louis Vuitton as a company/investment, but the valuation has fallen so much that it could be an interesting undervalued stock, and with a high dividend. So this could also be interesting for dividend investors. First of all, the Morningstar fair value estimate is €450 according to their analysis. I must say, from experience with Morningstar, it can take a very long time before the fair value estimate is reached, and sometimes, when a stock continues to decline, they suddenly keep adjusting their fair value estimate downward. But that is of course very difficult, and you must always be able to calculate the intrinsic value yourself. The current price is $235, so the margin of safety rule of 50% that Warren Buffett advocates based on his mentor Benjamin Graham would apply here. So invest in high-quality companies with a strong brand and always with a 50% margin of safety. This could be applicable here. Kering even receives a 5-star rating from Morningstar. They provide some advantages and disadvantages, as all analysts do. Ultimately, you have to make your own choices. And in this video, I present just a few sources of inspiration with high-quality data sources and analyses to help shape your decision. I do not own shares in Caring myself, nor am I interested in them. But that does not mean this video cannot be valuable for you if you are interested. For example, the historical valuation as we see here. As mentioned, in 2021, the price was indeed very high with a price-to-earnings ratio of around 35. Not extremely high, but it turned out to be much too high, and we now see that the stock price is declining significantly. Actually, the stock price is now starting to trade around the fair value line and below the standard multiple line. This could be quite interesting. Look, we have a short-term earnings analysis up to 2026. Expected analysts, a total of 25 and 20 analysts, predict that the EPS will grow by about 13 and 17% per year. The current PE ratio has dropped to around 14 or 13. Another source indicates 13. It could be that 2024 will not be a good year for the company, which may lead to further declines in the stock price in the short term. However, if we can regain some momentum afterward, we can focus purely on the PE. From 15, the stock could achieve a return of about 10% per year, and that is including the high dividend. At the moment, the dividend is quite high. If we look at the normal multiple, let's say it is around 20, or we take the price-to-earnings ratio of 18, then Caring could even reduce its annual average return from above 15%. So it really has interesting characteristics, but the question is, what will the new CEO do? Can they regain the momentum? It is not only Caring that is affected by a cyclical movement in fashion brands and declining revenue growth. Louis Vuitton and other types of fashion brands are also affected by this cyclical movement, and the question is, of course, how long it will continue. If it lasts longer than expected, the market will react to that in the short term, and the stock price will become even cheaper. The current price-to-earnings ratio of Caring is around 14, and the projected ratio for next year is around 19. The 19 is now super interesting and is in line with the sector median. The EV/EBITDA is below 10, which is favorable. And we see here the price-to-cash flow, which is around 7, and that is also favorable. We see a dividend yield of 6%, but there is a significant but regarding Caring, and that is the total debt. They have a total debt of 20 billion, of which long-term debt is around 11 billion. The cash position may still be sufficient in the short term, but the higher the debt, the higher the interest costs. Let's look at the dividend and then the finances. First, the dividend. The company has been paying out dividends for 12 consecutive years. There is indeed some degree of dividend consistency. However, there is hardly any dividend growth. In the dividend scorecard, there are several factors needing improvement. So, it is not the best dividend stock available. Regardless of the situation, the dividend yield is currently 6%, which is high. There is significant debt involved, 20 billion in debt. We have an EBITDA of 5 billion here. Divided by 20 is 4. EBITDA ratio, 4. Above 3. Ideally, below 3 is better. The company's long-term debt is high. There's a downward risk. This is crucial for understanding the financial health. What is your criterion for risk? My criterion for risk is permanent loss of money. I do not want permanent loss of money. Companies with large, significant debts relative to EBITDA can really face serious problems, even going bankrupt, so be careful with this. And I also took a look at the trend. You can see from 2018, 2019, and 2020 when debt was very cheap. The debts were still relatively low compared to the current debt level. So apparently, purely based on this trend, the company needs money and has attracted funds to solve short-term problems. But the question is, will this succeed? Yes or no? So, purely for this reason, I wouldn't really get very excited about Caring. Even when I look at the revenue figures for both the short-term and slightly longer-term, I don't find this company very appealing. For me, this is already a skip. Certainly in relation to all the opportunities, all the chances that are available, and all the great stocks, we publish weekly analyses of value, growth, and dividend stocks on our website. We have all sorts of much better opportunities with much less risk than Caring. At least, that seems to be the case. However, as I mentioned earlier, based on the forecasting projections, purely on the basis of facts and data regarding EPS growth, it could be an interesting entry point, as long as you take the high debt into account. The profitability of Caring is indeed good, and this also shows that it has a healthy market position, at least in relation to the sector median, but also compared to industry peers. Also, a healthy net income margin that was actually much higher before, at 16%, 16% is actually quite good. And the whole day, it is 11%. So here, this is favorable. Why? Because if the company can resume its momentum, then the profit margin can also rise again. For example, to that 15% or maybe even more. Yes, and suddenly a PI of 13 doesn't seem like much anymore, so this is very important. I just think that in the short term, it is a bit too early to determine whether I should invest now. Zegshenk indicates a strong sell, but does not provide the in-depth analyses that we often do. It also has to do with the fact that this is a company from France, and Zegshenk is more focused on USA equities. This means that you could gain a network potential of minus 25%. It's never really certain, and there isn't really a significant support line to be found here. Yes, maybe at the price level of 185, but that still implies a downward potential of minus 25%. This means that Kering's stock would have to drop significantly compared to the last peak. However, you should not take that last peak into account. It was clearly overvalued. However, let's look at 2022, minus 45%. It could very well decline further. A brief conclusion based on a number of facts and data. A very cautious conclusion is that, at the very least, the valuation seems to have become more interesting for long-term investors. Everything depends on whether Kering can grow further in the short term and also in the long term. And if you are an optimist and believe in brands like Gucci, which accounts for 70% of their revenue, then the entry point is starting to look more attractive. Perhaps the best methodology here is dollar cost averaging. Who knows? Much more importantly, you need to conduct much more research on this company, look into the annual reports, and formulate your own scenarios while strongly considering the high debt. Look at what the downside potential is, and perhaps in the short term, the stock may decline, which could present an even better opportunity at that moment.